Over the past Shibami onths, there's really only one high-octane money-making play in global public markets. Bet big on NVIDIA, from just a tool supplier to the undisputed king of the AI empire. NVIDIA grabbed nearly all the first-wave windfall from generative AI. But our investment team dug into the latest capital spending numbers and Silicon Valley's compute hardware logistics data and uncovered a harsh reality that should give a lot of investors chills. NVIDIA sold out every last GPU and raked in massive, outsized profits. Meanwhile, billions of dollars worth of compute hardware are getting shipped into data centers across the globe. The big question is, who's actually running all this insanely expensive gear? Back in cloud computing's golden era, AWS blew up into a $100 billion business by renting out CPU-powered servers. Now, we're in the AI era, so who's going to be the next AWS for AI? Who's loading up on expensive GPUs by piling on debt? And which legacy data center players are just putting on a show, about to get wiped out by this new wave? To really understand this space, we need to rewind the clock over the last 3 years, the era of scarcity, desperate GPU shortages back then. Larger language model founders had tens of millions in funding, but couldn't get their hands on a single HLN. NVIDIA held total control over chip allocations. Over in Silicon Valley, everyone bought into the mantra, compute is the new oil. If you could get your hands on GPUs, you could raise money from VCs. The infrastructure boom, explosive build-out. This is when the cloud computer rental market blew wide open. Specialized cloud providers, dubbed Neoclouds, outfits like CoreWeave, Lambda Labs, and Together AI, shot to prominence fast. They went all-in on aggressive debt financing, borrowing money from Wall Street, using GPUs as collateral, snapping up tens of thousands of chips, and blowing up their revenue multiple times, over by renting out compute capacity. The Great Divergence, sorting out the next batch of winners. By the market shifted entirely. It was no longer just about whether you had compute access. Now, it was all about efficiency, renewal rates, and solid business models. Big AI players started crunching ROI hard. Open source models and homegrown chips closed in from two sides. Middlemen who just flipped compute for a quick markup saw their profit margins get squeezed. Meanwhile, operators with in-house orchestration software, optical network edges, and locked-in long-term contracts are pulling far ahead of low-grade data center players. Most regular investors only look at the big tech capex numbers. But after digging deep across US public and private markets, we found the real alpha is hidden inside these specialized GPU cloud providers that control the lifeblood of global AI compute. To fully map out this investment landscape, our team spent months putting together this exclusive US GPU compute rental investment database. In this video, we're breaking these venture companies down into 4 key groups: heavy asset debt leverage crew, compute giants that locked in billion-dollar valuations by financing GPUs as collateral, light asset orchestration, decentralized players, platforms that don't own hardware. They use software to pool up idle compute resources worldwide, legacy IDC former cryptomine converts, local operators that pivoted from Bitcoin mining into AI compute. Full-stack iCloud players, Silicon Valley upstarts offering end-to-end services, everything from raw compute all the way to model training. We'll walk you through each one. Fundraising totals, latest valuations, their real GPU inventories, top-tier backers like BlackRock, NVIDIA's own investment arm, Coatue, and more. And most importantly, can these businesses actually turn a profit? Whether you're hunting for the next shoe bagger in public markets or trying to understand who's really moving the compute hardware behind big tech, this video delivers hard-hitting, institutional-grade insights. Data's all set. Let's dive straight into the meat. A lot of investors ask, AWS, Microsoft Azure, and Google Cloud have dominated cloud computing for a full decade. Why would startups rent GPUs from newer players like CoreWeave? Here's the thing. Legacy cloud and GPU-optimized cloud aren't even the same animal, from their underlying physical hardware all the way down to their business playbooks. Let's break down the key difference. Hyperscalers built their infrastructure for general-purpose computing. If you spin up tens of thousands of GPUs on AWS for large model distributed training, network latency and heavy virtual machine overhead eat away over 5% of your total compute performance. Meanwhile, these new generation Neocloud GPU clouds were built from day one for AI supercomputer clusters. They run bare metal hardware, lossless fiber interconnects, plus custom liquid cooling setups. Most importantly, their pricing is cheaper than AWS. On top of that, you can lock in thousands of GPUs running non-stop for months without crashes. At its core, the GPU cloud business isn't really about selling software services. It's about renting out the scarcest production resource of the AI era. From a capital markets perspective, if we're hunting for the best risk-reward opportunities across this supply chain, we have to break down how well each of these 6 segments captures value. Let's walk through how capital actually flows through this ecosystem. Chip layer, NVIDIA 30MD, they pocket the bulk of the industry's hard profits, with gross margins north of 5%. For public market investors, though, NVIDIA's valuation has already priced in a huge chunk of its future growth expectations. End-user applications, Sunti model layer, OpenAI Sudi AI SaaS. Right now, this space is defined by sky-high burn rates and terrible ROI. Chasing a shot at AGI, large model firms end up pouring nearly all their raised funding straight back into compute capacity. GPU cloud compute layer, the core battleground. This is one of the most reliable DCF nodes in the whole chain. Large model players hand over billions in cash to GPU cloud operators and lock in non-cancelable E-to-10-year rental contracts. That gives us this rock-solid investment thesis for the sector. Power and IDC set the physical hard limits. No matter how many GPUs you buy, they're just inert silicon without power. At the end of the day, computer rental companies compete over who can secure megawatt-scale power allocations and access to state-of-the-art liquid-cooled data centers. Leverage arbitrage and depreciation risk are make or break. The computer rental business boils down to tapping cheap Wall Street debt to buy expensive GPUs, then leasing those chips out to AI firms at steep monthly rates. Operators profit off the spread between financing costs and rental income. But here lies the biggest investment risk. If GPU prices drop, or next-gen chips, like the B18 by Rubin rollout too fast, will accelerated depreciation on older hardware, such as the H-Yalinin, blow up these companies' balance sheets. To figure out where the valuation ceiling sits for the computer rental space, we first need to look at how the world's top investors and research firms are pricing this massive AI infrastructure build-out. According to recent reports from Goldman Sachs and SemiAnalysis, cumulative global capex for AI infrastructure, covering GPUs, optical modules, servers and data centers, will blow past $1 trillion by 2030. Let's go through the core valuation frameworks from 4 leading institutions. SemiAnalysis runs extremely granular numbers, working backwards from TSMC's CoWoS packaging capacity at chip fabs. They project that over the next 3 years, the annual cash flow generated purely by GPU hardware rental and hosting markets alone will hit $1.5 billion. McKinsey looks at power and data center build-outs. They estimate that global physical investment into data center construction will reach $10 trillion by 2030, with over 5% of that compute consumption tied to GPU rental and hybrid cloud hosting. Morgan Stanley offers a sharp real-world comparison. The full infrastructure build-out for the last mobile internet wave, G+ smartphones, stretched across nearly 2 years. By contrast, this trillion-dollar generative AI build-out is unfolding 10 times faster, all crammed into just a handful of years. What does this all add up to? Compute rental is no fleeting short-term trend. It's a trillion-dollar scale public utility business that's reshaping global IT infrastructure. A lot of people are asking, data centers are popping up all over the globe. So why are over 500 of the most profitable, best funded, highest valuation computer rental startups based right here in the US? The answer is straightforward. The US is the only place on Earth with a closed-loop, four-priced competitive moat tying together GPU supply, software ecosystem, debt leverage, and power resources. Let's break down these four game-changing advantages. Number 1. Priority GPU allocation. NVIDIA's Inner Circle Club. NVIDIA is headquartered in Santa Clara, California. Under the Global Allocation and Rationing System for HE/S and B Lambda, homegrown US players like CoreWeave and Lambda Labs get first dibs on tens of thousands of top-tier GPUs. They even land direct equity investments from NVIDIA's own venture arm, NVentures. In the AI era, scoring those chip allocations means locking in real assets. Number 2. The world's largest buyer ecosystem for cloud and AI. All the biggest US-based AI startups, OpenAI, Anthropic, Zatai plus legacy, tech heavyweights Microsoft, Meta, Google, and Amazon are stateside. Take XI's Colossus supercomputer cluster in Tennessee. It can eat up over Yowling lean GPUs in one go. With all these buyers practically next door, computer rental firms can sustain equipment utilization rates north of 500 over long stretches. Number 3. Aggressive Wall Street, Nasdaq leverage tools. In Europe or Asia, it's almost unthinkable to borrow billions from banks using graphics cards that could lose value down the line as collateral. But US capital markets have Wall Street heavyweights such as Blackstone, Magnetar Capital, and PIMCO building custom asset-backed debt financing solutions. For compute operators, these firms only need to put down a 500 down payment to borrow billions for GPU purchases, and crank up leverage even further through asset-backed securitization, or ABS. Number 4. Underlying power resources and geographic advantages. Texas, Virginia, Arizona. At the end of the day, GPUs just turn electricity into computation. The US boasts uniquely mature, geographically diverse regional power grids. Virginia, home to Data Center Alley, handling nearly 500% of the world's internet traffic with ultra-dense fiber backbone networks. Texas runs on its independent ERCOT power grid. Abundant wind, solar, and natural gas power make it the top spot for AI supercomputer hubs and former cryptomineta centers. Arizona, geologically stable, sitting well outside earthquake zones, with massive nuclear and solar power build-outs underway, put GPU allocations, end-user demand, Wall Street leverage, and Texas-grade power together, and you get total US global dominance in the GPU computer rental space. Now, who's quietly raking in big money across this trillion-dollar sector? Coming up next, we dive deep into part 4 of this video. Our full breakdown of the 4 major factions among these century GPU computer rental companies. If you look at today's USTech landscape, you'll quickly realize not every company holding GPUs makes the same kind of money. Based on core business models and capital structures, we can split the entire GPU computer rental market cleanly into 5 distinct groups. First up, sitting at the very top of the pyramid with unmatched certainty, the AI hyperscalers, the legacy cloud giants. AWS Amazon Web Services business model, classic GPUs plus full-stack cloud ecosystem. AWS doesn't just rent out top-tier NVIDIA hardware, it ties GPU compute tightly to enterprise cloud storage, security compliance, and databases via its SageMaker and Bedrock software platforms. Competitive edge, sky-high switching costs. Even if companies know CoreWeave offers cheaper H-Yowlin instances, moving tens of terabytes of data off AWS means steep egress fees, plus major operational headaches. Investment thesis, far from getting weakened by the AI boom, AWS has reinforced its monopoly as the king of enterprise-grade infrastructure, thanks to high-margin AI APIs and hybrid cloud hosting services. Microsoft Azure Core Play exclusive compute backbone for OpenAI. By pouring billions into OpenAI, Azure locked down the world's biggest single AI compute consumer. It also baked Copilot deep inside the MCNW ecosystem, turning compute expenses into high-margin SaaS subscription revenue. Competitive edge, ein unrivaled global enterprise sales pipeline. Google Cloud, GCP differentiating superweapon, its in-house, TPU, tensor processing unit, chip ecosystem. Google is the only hyperscaler that isn't fully reliant on NVIDIA. Apple bought massive TPU cluster capacity on GCP to pre-train its Apple intelligence models. That gives Google the industry's strongest CapEx buffer and negotiating leverage whenever NVIDIA raises prices. Next up is the second group within the GPU computer rental space. Pure-play specialized GPU cloud providers, also known as Neoclouds. This segment delivers the biggest upside, draws the most debate, and has birthed the largest number of shoe-bagger candidates. The poster child for this group is CoreWeave, which just went public on US markets. CoreWeave, the wild, leveraged rise of a compute empire company. Background: founded back in 2017, it actually started out as a Bitcoin mining firm. It then made a sharp pivot toward GPU compute infrastructure and landed on the Nasdaq in 2018 under ticker CRWV. Business model: ultra-pure GPU infrastructure resacer. No bloated extra software stacks. It delivers nothing but high-performance bare metal GPU supercomputer clusters. GPU scale, financing, operates hundreds of thousands of top-tier NVIDIA GPUs. It has massive debt, backing from heavy-hit hedge funds, including Kochu and Magnetar Capital, plus billions in direct equity and compute synergy investments, straight from NVIDIA itself. Key clients: Microsoft as supplemental compute capacity, OpenAI, Meta, and Cohere. Institutional take: a pure alpha play. It's arguably the cleanest public market proxy for the AI compute boom, with revenue blowing up multiple-fold year-over-year. Critical flaws and fatal risks: fragile balance sheet. CoreWeave built its business on asset-backed debt secured against its GPU hardware. If demand growth for large model compute cools down, covering its multi-billion-dollar high-interest debt becomes extremely challenging. Depreciation cliff: hardware like the H-Yaolinin and H-Arlinin will get heavily obsoleted within 3 to 4 years by next-gen chips, such as the B-Arlinin and Rubin architecture. If customer contracts fail to cover costs within that depreciation window, paper profits can flip to losses overnight. Lambda Labs, Silicon Valley's fan favorite among developer community's market positioning, go-to GPU cloud for AI developers and smaller AI labs. Core strength: outstanding developer UX, one-click ready-to-go PyTorch and TensorFlow environments. It enjoys massive goodwill and tight community loyalty among Silicon Valley AI engineers. Finances: Valuation. Private market valuation sits between $1 billion. Prepo fundraising efforts are already underway. Investment risks: compared to heavyweights like CoreWeave, Lambda has far less capital firepower. It cannot tap into the same debt leverage to secure hundreds of thousands of GPUs all at once, leaving it vulnerable to getting pushed aside when bidding for large enterprise clients. A marketplace matching system plus serverless compute aggregation. Instead of spending billions buying chips and building out data centers itself, RunPod builds high-efficiency orchestration software. It pools scattered idle GPU capacity worldwide, sourced from small IDCs, former crypto mines, and even individual operators, and rents it out to developers. Core strengths: ultra capital-light operation, no massive debt or hardware depreciation burdens weighing down its balance sheet. Extreme flexibility, billing by the second or hour, no mandatory 3-year long-term contracts. Developers can fine-tune a model for just a few bucks. Its annual recurring revenue has exploded, doubling within a short time frame. Key risks and weak moat, network latency limitations, cannot handle large model pre-training. Since compute nodes sit across geographically separate data centers, there is no InfiniBand high bandwidth interconnect between them. RunPod works great for inference and small model fine-tuning, yet it cannot support distributed parallel training for trillion-parameter models. Its technical moat is shallow, relatively low barriers to entry, so it gets dragged into brutal price wars against decentralized competitors such as Vast. Now that we've covered these three distinct business models, in part 5 of this video, we'll break down the remaining two groups: legacy cryptomine converts, IREN, core scientific, and full-stack iCloud players. We'll wrap it up with institutional-grade stock-picking strategies for the entire sector after going through this full-picture database covering Sentia companies. What exactly should public market investors look for to pick winning stocks that can actually generate real profits? Digging through balance sheets, we've summed up 3 major red flags to avoid and core stock-picking principles used by institutional players. Golden rules for picking stocks. Prioritize megawatt, MW power capacity over raw GPU chip counts. GPUs can always be purchased later. Secured high-power physical electricity allocations are the true scarce asset. Watch out for high-interest unsecured debt risks. When pure-play GPU rental firms push leverage above Bifenjabarsha, fast-paced hardware depreciation can easily trigger debt defaults. Watch for valuation rare among former cryptomine converts IREN, cords. These companies already own pre-built power conduits, transformers, and land. They can spin up AI server racks at some of the lowest build costs worldwide. Rule Footy focus on megawatts, not just GPU counts. Lots of investors fixate on how many HE by S or B Lam by S a company announces it will buy. Institutional investors lead with locked-in megawatt-scale power capacity. Firms like Nebius, NBIS, and Core Scientific Cords got massive valuation ratings precisely because they hold hundreds of megawatts, even gigawatts, of live-connected power. In the Stanley AI arms race, whoever controls power allocations holds serious negotiating leverage over big tech buyers. Rule 50R. Beware the leverage and depreciation minefield. For pure-play Neocloud GPU rental operators, keep a close eye on debt maturity dates alongside GPU hardware depreciation timelines. If a firm bought chips using debt carrying over Bifenjashu annual interest, and HE by ME monthly rental rates drop Bifenjashu due to market supply-demand balance, interest payments can wipe out net income overnight. Rule C-SEN. Re-evaluate the asset value of cryptominator compute operators. Among these Sentia companies, many of the best risk-reward hidden plays sit within the former Bitcoin miner cohort, names such as IREN and Cords. Back in the crypto boom, they built high-capacity transformers, cooling towers, and secured land. Now they drop GPUs straight onto their existing power infrastructure. Their build-out costs run by Bifenjashu lower than building brand-new data centers from scratch, and they can go live more than Xiaomi onths faster. With the underlying data and investment frameworks for these Sentia firms under your belt, you've essentially built top-tier insight into the global GPU compute sector. If you go through the position reports from Wall Street's top hedge funds and Silicon Valley's elite VCs over the past Xiaomi onths, you'll spot an interesting pattern. While public markets were selling off AI application stocks and questioning whether large model businesses could ever turn real revenue, top-tier institutions have been pouring hundreds of billions of hard cash into GPU compute infrastructure at an unprecedented pace. Why is that? Underlying Wall Street and Silicon Valley investment philosophy is this: models get updated, consumer apps come and go, but infrastructure remains the steadiest way to capture the sector's overall beta. In this section, we dive deep into the definitive outlooks from 4 leading institutions on this space. Let's walk through their reasoning and figure out exactly what the smart money is seeing. First up, we've got SemiAnalysis. the hardcore global think tank focused on compute and semiconductors. Their research is super technical and grounded in real-world physical constraints. In their latest AI infrastructure report, they lay out two game-changing takeaways. Takeaway 1. The bottleneck for GPU compute is shifting away from chip output and toward power and networking inside physical data centers. SemiAnalysis points out you can crank up chip production if you throw more money at it. But building power transformers, liquid-cooled server racks, and securing grid connections takes 2 to 4 years to finish. That means physical data centers with multi-megawatt high-density power capacity command a massive premium. Whoever locks in power quotas gets to set the upper limit for usable GPU supply. Takeaway 2. AI infrastructure has officially entered the compute credit era. SemiAnalysis's model highlights we're inside a $1 trillion capital cycle, and plain equity funding alone can no longer foot the bill for massive GPU purchases. Wall Street credit markets, including debt guarantees and debt financing backed by NVIDIA, have become the main growth engine for GPU rental players. This model uses GPUs as collateral for billions in asset-backed debt. It's let Neoclouds like CoreWeave and Nebius scale at exponential speed. But there's a catch. If GPU rental rates drop faster than projected, heavy financing costs and interest payments can spark an immediate leverage-driven meltdown. Then we've got Silicon Valley VC powerhouse, APLD, Andreessen Horowitz. They bring a totally different big-picture framework, rooted in tech history evolution and value capture. In their research series titled, Who Owns the Generative AI Tech Stack?, APLD lays out these key observations. Non-stop cutthroat competition at the application and model layers, application layer. The barrier to entry is pretty low. You're dealing with brutal copycat competition and crazy high customer churn rates. Base model layer, to stay ahead in the race toward AGI, both open source and closed source heavyweights are locked in this capital-burning race to the bottom, with open source price wars. Sustaining sky-high gross margins here in the short term is really tough. Value ends up stacking up inside the infrastructure layer. APLD's math shows for every $1 raised by large model and AI application companies, over $1 ultimately flows straight into infrastructure. That means GPU cloud compute platforms, distributed databases, and supercomputing data centers. APLD's core investment thesis goes like this. No matter which big model player wins out, or which AI app blows up, every single one of them has to keep paying that compute toll to the infrastructure layer. That's the fundamental reason top-tier VCs are slapping multi-billion-dollar valuations on GPU cloud platforms, even when those businesses have little to no revenue or thin profits. Wall Street investment bank heavyweight Goldman Sachs takes a classic macroeconomic and capital cycle lens, laying out an ultra-clear 4-stage AI investment roadmap for US stock public market investors. Goldman Sachs strategists point out that US equities are right now in the golden boom and repricing window of Phase R. The infrastructure phase. CapEx is nowhere near its peak. More than 60% of annual capital spending from the big F4 tech players, Microsoft, Meta, Google, and Amazon, is going straight into GPUs and data center infrastructure. Doubts over ROI won't slow the infrastructure build even as the market questions how fast large model businesses can monetize. Tech giants would rather overinvest than underinvest. They cannot afford to miss out on the next era. The playbook for stock picking is shifting. During Phase R, public market capital won't just pile into NVIDIA anymore. Money will spread out into hosting firms that can quickly deliver power and compute racks. Names like Core Scientific and IREN, as well as GPU cloud service providers. Last but not least, Morgan Stanley released a specialized research report laying out the full supply chain, value spillover, and investment roadmap. Morgan Stanley stresses that GPU compute rental doesn't exist in a vacuum. It acts as the critical hub, linking physical upstream hardware to end-user compute demand downstream. The bank highlights three major supply chain spillover areas with strong upside. Networking to optics as GPU clusters scale from tens of thousands up to hundreds of thousands of cards. Think based nodes, network latency becomes the biggest bottleneck. Companies building high-bandwidth InfiniBand hardware and BABIGFLEDENLIOT optical modules are set for highly predictable growth. Liquid cooling, thermal management rack power density, has exploded from the old SHU kW all the way past Yalinin kW per cabinet. Traditional air cooling solutions no longer work. Cooling providers such as Vertiv are locked into expansion plans alongside GPU rental operators. Power grids signed, independent power producers, IPs Morgan Stanley puts it bluntly, I ultimately boils down to nuclear and natural gigas power. Nuclear giant Constellation Energy and power heavyweight Vistra have locked in decade-plus long-term power supply deals with big cloud players and GPU compute hubs. This has earned them a far bigger valuation premium than regular utility stocks. Final takeaway from Wall Street institutions, pulling insights from all four research firms. One crystal clear USC stock investment theme emerges. The first act of the AI revolution belongs to chips, namely NVIDIA. The middle act centers on infrastructure and compute rental, GPU cloud platforms, power capacity, and data centers. Only in the late game of the AI revolution will software and consumer applications take center stage. Once you grasp this capital market logic, you'll have the calm, forward-looking institutional-grade perspective most retail investors lack, even when markets swing wildly, even after going through all the macro trends and our database covering those censure companies. Plenty of investors are still left scratching their heads. When a compute power firm announces it's just bought tens of thousands more BRD-leaning GPUs or locked in a multi-billion-dollar compute contract, how do you actually tell whether its stock is cheap or overpriced? Top Wall Street hedge funds never just take management's PowerPoint pitches at face value when valuing these assets. Instead, they build something called a GPU asset return sensitivity model. Today, we're breaking down this institutional-grade analytical framework, the kind that costs tens of thousands of dollars to access, into 5 key quantitative metrics. Master these 5 numbers, and you'll instantly understand the underlying asset quality of any GPU cloud player. Metric SUI, actual GPU fleet size, asset mix breakdown when you're evaluating a compute infrastructure company. Don't start with whatever number of GPUs they claim to own. Start by digging into their chip generation mix. Asset quality weighting, let's say a firm has Wu-Chen GPUs total, 50,000 HE/S are in a completely different league in terms of asset value and rental pricing power compared to 50,000 BRD-lean GB-RD-lean NVL Chisha units. Depreciation, red flag from hardware iteration, HE/S are getting pushed out of pre-training workloads and shifting over to inference-only use cases. Hourly rental rates for these cards are naturally trending down. If a company's balance sheet is loaded up entirely with older generation GPUs and it doesn't have long-term contracts locked in for 10+ years, its hardware assets face serious risk of sharp write-downs down the line. Metric SUI, our real-world GPU utilization rate. This is the most hidden, yet make-or-break metric for every GPU rental business. Every single second a GPU sits idle in the data center is pure money going up in smoke. Let's walk through Wall Street's basic revenue formula for compute businesses. Top-tier players like AWS, Azure, and CoreWeave maintain an impressively high utilization rate of 5%. They lock in huge anchor clients, such as Microsoft and OpenAI, under take-or-pay volume agreements. Mid-tier and decentralized platforms, certain second- and third-tier Neoclouds, for example, often only hit 5% utilization. Once utilization drops below 5%, rental revenue can't even cover data center, depreciation, and expensive rack hosting fees. Metric SUI, Sen physical power cost structure, Sen D geographic arbitrage advantage. At its core, GPU compute rental is basically turning electricity into AI compute tokens. As GPU hardware becomes more and more standardized down the line, whoever locks in the lowest per kilowatt or power cost will command the industry's best gross margins. Texas, abundant wind, solar and natural gas resources push industrial power rates down to cents per kWh each. This creates an unbeatable cost moat for former cryptomining turned iCompute operators like IREN and Core Scientific. California, industrial power costs run cents per kWh each. Building a massive GPU supercomputing cluster in California is basically like raising hogs on prime real estate. The business model barely makes economic sense. When Wall Street builds its financial models, P-power usage effectiveness gets crunched rigorously. For multi-10,000 PU clusters, every lean-den drop in PUE translates to tens of millions of dollars in extra annual net profit. Metric C, customer quality, VD contract structure. Customer credit, 2V duration. Two separate $1 billion order announcements can tell completely different stories. If the customer is Microsoft or Meta, and they've signed ironclad year irrevocable take-or-pay agreements, Wall Street will immediately hand the company access to very cheap debt financing, and its valuation multiples get a big boost. On the flip side, if the revenue comes from a bunch of cash-burning AI software startups that could go under any day, plus short-term spot rental retail clients, default and order cancellation risks shoot way up. The market will slap a steep risk-adjusted discount rate onto the business. Metric Sui Wu, capital efficiency and payback period. This is what every hedge fund manager cares about most. If you drop billion buying servers, how long until you get that money back? Under healthy investment model assumptions, an HGX bar GPU server that costs roughly $1 million will typically have a static payback period of Wu to 10 years. Assuming a % utilization rate and hourly rental rates of Wu per GPU. But if the payback stretches out beyond 4 years, while next-gen chips such as the Lean or Rubin roll out every 2 years, you've got a huge problem. The hardware becomes second-tier assets before you've even recouped your investment. That can trap the company in a dangerous self-reinforcing downward spiral. To sum it all up, GPU compute rental isn't just some straightforward hardware rental business. It's a high-stakes game that blends Wall Street financial leverage, geographically constrained power resources, low-level software, orchestration, and the total reshuffling of production assets in the AI era. From NVIDIA's explosive growth to the rise of CoreWeave and Nebius, and the full Avion competitive push from legacy crypto mining operators and established cloud giants alike, the future landscape of AI infrastructure is being irreversibly reshuffled. After Wushuofinzhong, UTs of deep dive analysis, we finally hit the ultimate question haunting investors worldwide. Inside this trillion-dollar megasector, who will become the AWS of the AI era? If we define becoming the next AWS as operating massive compute scale and capturing top-tier gross margins via software ecosystems, our Wall Street-style analytical model yields this final investment ranking, VTE. Untouchable legacy cloud giants, Microsoft Azure Ficity AWS Wes, Google Cloud position, undisputed market dominators, and stable investment anchors. Core thesis, far from getting wiped out by AI, the big hyperscalers have actually strengthened their competitive moats. They own the world's largest enterprise client base, sprawling data center footprints, plus a full-stack software ecosystem moat spanning cloud storage, all the way to AI APIs. For institutional capital prioritizing certainty and risk control, Tier E players remain the best way to capture the AI industry's long-term beta. Tier R, the compute giant closest to ARS, CoreWeave's position, highest upside, highest explosive growth, alpha play. Core thesis, Among pure-play Neocloud GPU cloud providers, CoreWeave is the only one with enough scale, orchestration capability, and financial leverage to meaningfully compete against the big cloud incumbents. It represents the closest prototype of a dedicated era AWS. Critical flaw: it is also the riskiest pick. Sky-high debt leverage and a fragile balance sheet make it a double-edged sword. It can deliver multi-bagger gains during a compute bull market, yet it's extremely vulnerable to brutal valuation contractions when rental rates trend downward. TSN, niche players with unique physical 20 ecosystem moats, Crusoe Energy Lambda, Labs position, specialized vertical market champions. Core thesis: Crusoe runs wastetakers and green power paired with data center operations, locking in some of the lowest power costs across the whole industry. It has built a formidable physical moat on sustainability and cost advantages. Lambda Labs, meanwhile, leans on outstanding developer experience to lock in Silicon Valley's most innovative large model startups and AI developer communities. Neither can take over the entire market, but both can thrive comfortably within their own protected niches. After walking through the full landscape of those GPU rental companies and Wall Street's valuation frameworks, we land on a profound business truth. In phase 1 of the AI revolution, the undisputed winner was shovel seller NVIDIA. But for phase 2 of the AI revolution, excess returns will inevitably flow to compute hubs that can operate GPU infrastructure efficiently. Over the next 5 to 10 years, brand new trillion-dollar giants will emerge within the US and global GPU computer rental space. Still, as rational investors, we cannot get fooled by companies bragging about how many GPUs they own. Every earnings season going forward, you need to keep a laser focus on these 4 key metrics: real GPU utilization rate, to check whether compute capacity is actually getting consumed, underlying per watt power cost, to gauge whether the business has a genuine energy cost moat, locked-in long-term take-or-pay contracts, to assess customer credit quality and cash flow predictability, capital efficiency and payback period, to see if the business can recoup its investment before the hardware depreciation cliff hits. Beneath all the grand generative AI hype, the true scarce resource has never just been silicon chips. What matters is a complete infrastructure system that seamlessly combines power, hardware, software, and capital to reliably deliver consistent compute capacity. That wraps up this Lucia-minute deep dive breakdown. We've put together the full institutional-grade Excel database, complete database of US GPU computer rental firms. Inside, you'll find for all 30 companies, latest GPU fleet sizes and chip generation asset mix, estimated per GPU, hourly rental rates and gross margin projections, physical power capacity in megawatts, plus detailed lists of key investors how to get it. Subscribe to the Edge of Competence channel, like this video, and drop your thoughts or email address in the comments section. Our backend system will send you the download link right away. We unpack our stocks through an institutional lens and chase alpha with hard real-world data. Thanks for sticking around. Catch you in our next deep dive video.